We have a quick question here from a subscriber who says that they often find themselves a little bit confused and paralyzed when the market shows disjointed moves across some asset classes. And we've recently seen some pretty big moves in equities, which did take a while to really follow through to some of the high beta and the safe haven currencies. And they just want to know how to better navigate these types of disjointed moves. Now, the moves they're referring to here is basically what we had a couple of sessions ago, where equity markets in blue here, we have the S&P 500. We saw equity markets moving down sharply lower, but at that same time, we actually saw just very range-bound moves in a very classic risk proxy, for example, like the Aussie yen. You'd normally expect the Aussie yen to follow equity moves lower, and that just wasn't the case for a couple of sessions in a row. So thanks for the question. And it's a very important one as well, because these types of environments you are describing, they actually happen a lot more, I think, than most traders realize, especially once you get into the habit of going through various asset classes and looking at things like cross-asset volatility. You get into the habit of picking up on some of these potential disjointed moves very quickly. Now, in my opinion, there's really only two ways that you can look to navigate these types of environments. And that is firstly by looking to potentially exploit them for opportunities, and secondly, by just staying out of them completely. And I'm sure you can imagine that the option you should choose between these two will largely depend on your experience as a trader. Meaning that if you are a beginner or novice trader, it will probably be very hard to try and pick up on the finer nuances when these things happen. That could create some trading opportunities when you see these disjointed moves happen. And just as an example, in your question, you refer to these recent moves we've had in equities, which did take some time to follow through in the FX space. Now, there is really only two things that can happen in that type of scenario. And that is either equities will recover back to the upside and move higher in line with that more sideways movement that we saw in something like the Aussie yen. Or apart from that, we're going to see some catch-up trades to the downside, where the FX space will need to basically catch up and reflect the moves that we've seen in equities. Now, recently, of course, we saw that even though it was moving sideways, eventually the currency space caught up to these moves in equities and also followed it lower. Now, at other times, you might see the bond market, for example, giving you a clear signal that things might not be as rosy as equities might be portraying it. A good example would be if you see equity markets are rising across the board, but bond yields are moving down sharply. And that can normally show you that things might be under the surface, even though equities are higher, under the surface, things might not be as clear. And again, you can try and exploit some of those opportunities there, because you're either going to see bond yields move higher from there to try and catch up with equities, or you're going to see equities catch up to the downside with the moves we saw in bond yields. And that can create some trading opportunities, but it's important with these types of trades to be able to realize in those scenarios which outcome has the higher probability. So, for example, in these moves we had with equities and the Aussie yen, a novice trader might spot the disjointed moves. They might see that, okay, equities are moving lower, but the Aussie yen isn't moving lower. They might spot that by just doing normal intermarket analysis. And they might know that either one of them will need to catch up with the other, but they will probably not have the analysis and the market experience to know which outcome has the higher probability of that happening. And that's why, if you're approaching the market as a novice trader, and you're still finding your feet in the world of fundamental analysis and intermarket analysis, etc., my advice would be to rather just sit out of those types of events. And you will often hear Giles say, when in doubt, stay out. And it's so true. The best thing that you can do when you're unsure in those types of environments is just to stay out of the market. And because when you try to take a punt trade in those types of environments, it's likely going to just eat into your account in the long run and do more damage than good. So rather, if you're going to exploit these types of things, do make sure that you're more experienced and that you know how to exploit them. But if you're still hesitant, whenever you feel that you're not sure why the market is moving the way it's moving, the best thing that you can do in those environments is by protecting your capital and just staying out of the market until a clear opportunity presents itself.